Welcome back. Today we're putting 6 trending stocks under the microscope. We'll break down TROO Inc., SQFT Presidio Property Trust, IBG Innovation Beverage Group, SDST Stardust Power Inc., Sonnet Biotherapeutics, and MGRM Monogram Orthopedics. For each, we'll cover what they do, recent performance, and the key pros and cons. Remember, this isn't financial advice, just a starting point for your own research. Always do your own due diligence before investing. Let's jump into the first stock. First up is TROO Inc., a digital marketing and social media management company. TROO Inc. helps businesses build online communities, offering content creation, analytics, and strategy on a subscription basis. Their scalable model targets small and medium businesses that can't afford in-house teams. The digital marketing space is huge but also crowded. Competition is fierce and client retention is a constant challenge. TROO's recent stock performance has been volatile, typical for small tech firms. Key questions: are they growing revenue, managing expenses, retaining clients? The upside: if TROO can carve out a niche and automate services, margins could improve and growth could accelerate. The downside: intense competition, high client churn, and the risk of cash burn without profitability. Investors should watch for client retention rates and financial health, especially cash on hand and debt levels. Ultimately, TROO is a high-risk, high-reward play that depends on execution and differentiation. If you believe in their management and strategy, it's worth watching. But be cautious. The digital marketing world moves fast, and only the most adaptable survive. TROO's future hinges on their ability to stand out and scale efficiently. For now, it's a speculative bet in a crowded field. Keep an eye on their client wins and financial updates. If they start showing consistent growth, the story could get interesting, but for now, approach with caution. TROO is one to watch, not chase. Let's move on to the next stock. Next is SQFT Presidio Property Trust, a diversified real estate investment trust, or REIT. SQFT owns office buildings, retail centers, and model homes, aiming for stability through diversification. REITs must pay out most of their income as dividends, making them attractive for income investors. But the office sector faces headwinds from remote work, raising vacancy rates and pressuring rents. Key metrics: property quality, location, and especially funds from operations (FFO) to cover dividends. A high dividend yield can signal risk if it's not supported by FFO. Rising interest rates increase debt costs and can hurt REIT profits. SQFT's diversified model could help weather sector downturns, but office exposure is a real risk. If you believe in a recovery for office real estate, SQFT might be undervalued. But if negative trends persist, dividends and share price could suffer. The opportunity: steady income and potential value if the sector rebounds. The risk: ongoing weakness in commercial real estate and higher rates. This is a classic value play with sector-specific challenges. Do your homework on their property portfolio and debt load. SQFT is for patient investors willing to bet on a turnaround. If you want income and can stomach volatility, it's worth a look. Otherwise, there may be safer REITs out there. Let's check out our next company. On to the beverage sector. Now let's look at IBG Innovation Beverage Group, a small player in the competitive beverage industry. IBG develops and markets unique alcoholic and non-alcoholic drinks, aiming to catch consumer trends. Their success depends on launching products that resonate and securing big distribution deals. The global beverage market is massive, and a single hit product can transform a company. Early-stage beverage firms often aren't profitable. They focus on revenue growth and expanding distribution. Watch for sales momentum and new retail partnerships as key indicators. The upside: if IBG creates a popular brand, it could attract a buyout from industry giants like Coca-Cola or Diageo. M&A potential adds speculative appeal. The downside: the beverage market is brutally competitive with high marketing and distribution barriers. Most new brands fail to gain traction. Consumer tastes shift quickly, so IBG needs a pipeline of new products to stay relevant. Execution is everything. Brand building, marketing, and distribution must all click. For investors, this is a high-risk, high-reward bet on innovation and management. If you believe in their products and team, it's a speculative growth play. But be prepared for volatility and the possibility of failure. Research their product lineup and distribution network before investing. IBG is a story stock. Success hinges on consumer adoption. If they land a big retail deal, the stock could pop. Otherwise, it's a tough road. Let's move to the next sector: battery materials. Here comes Stardust Power. SDST, Stardust Power Inc. is targeting the lithium refining market, crucial for electric vehicles and energy storage. They plan to build a US-based lithium refinery, aiming to supply battery-grade lithium domestically. Most lithium refining happens in China, so a US facility is strategically important. Demand for lithium is set to soar with EV growth, and government incentives support domestic projects. Stardust is pre-revenue and highly speculative. Success depends on building and operating a complex refinery. Risks include construction delays, cost overruns, and technical challenges. Lithium prices are volatile. A price crash could devastate the business model. Competition is heating up, with other firms also racing to build North American capacity. Stardust's story is a bet on execution, government support, and sustained lithium demand. There's no revenue yet. This is a venture-style investment. The upside: if they succeed, Stardust could become a key player in the US battery supply chain. The downside: failure to execute could mean total loss. Watch for project milestones, financing updates, and government backing. This is not for conservative investors. If you want exposure to the battery revolution and can handle risk, Stardust is worth tracking. Otherwise, stick to established lithium producers. Stardust is a moonshot, big potential, big risk. Next, let's dive into biotech with Sonnet. The stakes get even higher. Here's what you need to know. Sonnet Biotherapeutics is a clinical-stage biotech developing new cancer therapies. No approved products yet. Their value lies in their drug pipeline and proprietary delivery technology. Success depends on advancing drug candidates through clinical trials and eventually winning FDA approval. A single successful drug can be worth billions, but most candidates fail in trials. Stock prices swing wildly on trial results. Positive data can send shares soaring, negative news can crush them. Financing is a constant challenge. Clinical trials are expensive, and dilution is a risk as new shares are issued. Always check their cash runway. How long can they operate before needing more funds? Regulatory hurdles are high, and even promising drugs can be rejected or delayed. Sonn is a pure speculative play, betting on science, management, and a bit of luck. The upside, a breakthrough, could mean massive returns. The downside, failure, could wipe out your investment. Only invest what you can afford to lose and understand the science and risks. Sonn is for high-risk, high-reward investors, or those allocating a small portion to speculative biotech. Watch for clinical milestones and funding updates. If you're not comfortable with volatility, steer clear. For those who thrive on risk, Sonn is a biotech lottery ticket. Next, let's look at medtech innovation with Monogram Orthopedics. Can they disrupt surgery? Let's find out. MGRM, Monogram Orthopedics, is developing personalized joint implants using robotics, 3D printing, and AI. Their goal: custom-fit knee and hip replacements for better outcomes and faster recovery. They're building a robotic surgical system to precisely fit implants to each patient. Still in development, Monogram is pre-revenue and burning cash on R&D and regulatory approval. The market for joint replacements is huge and growing with an aging population. If Monogram's tech proves superior, they could disrupt a massive industry. The upside: better patient outcomes, recurring revenue from custom implants, and potential rapid adoption. The risks: regulatory hurdles, commercialization challenges, and entrenched competition from giants like Stryker and Johnson & Johnson. FDA approval is a major barrier, and convincing hospitals to adopt new tech is tough. Monogram must prove their system is not just better, but significantly better. Success could mean huge growth, failure could mean running out of cash. This is a long-term, high-risk bet on medtech innovation. Watch for regulatory progress and early adoption by surgeons. If they break through, the rewards could be substantial. But the path is full of obstacles. Monogram is for believers in disruptive healthcare tech. If you're patient and bullish on their vision, keep them on your radar. Now let's wrap up with some final thoughts. That's a rapid-fire look at TROO SQFT IBG SDST SONN and MGRM. Each offers unique opportunities and big risks. TROO and IBG are brand-building bets. SQFT is for income seekers with a stomach for real estate volatility. SDST, SONN, and MGRM are speculative plays on disruptive trends, potentially huge, but risky. Your decision should match your risk tolerance and conviction in each story. This isn't a buy or sell call, just a launchpad for your own research. If you found this helpful, hit like and subscribe for more deep dives. Let me know in the comments which stock you're watching, and I'll see you in the next video.